if you follow global events, especially what's happening in Northeast Asia, you've got North Korea, Taiwan, China, the U.S. It just feels like information overload, right?
Absolutely. It's like trying to drink from a fire hose.
Right.
Constant tension, new headlines every week.
Exactly. And it feels like every little flare-up could crater the global economy. It's hard to sort the noise from the actual signal.
Well, that's what we're trying to do today.
Yeah.
Our sources are arguing this isn't just random noise. They're describing a real fundamental paradigm shift in the region.
A paradigm shift. Okay.
Yeah, moving beyond, localized spats to something more structural. A crisis driven by what the reports are calling a triple pressure, hitting key U.S. allies, particularly South Korea.
Okay, so our mission for this deep dive is basically to cut through that noise, give you a shortcut. We want to look at the sources, understand the mechanism, like how exactly does this big geopolitical stuff translate into what happens to your money, your portfolio?
Right. And crucially, what assets might actually be a safe harbor when these traditional security assumptions start to look shaky?
This deep dive really connects the dots then between alliance politics and, well, market stability.
Exactly.
Oh.
We'll look at the actual winners and losers on the Korean stock market, the KOSPI, and interestingly, why some assets might be better hedges now than even things like U.S. Treasuries.
All right, let's unpack this. The sources say it's not just one problem, but three big pressures hitting all at once. Let's start with pillar one. They call it the Geneva Gambit.
Yeah, the Geneva Gambit. So reports, including analysis from the Financial Times, point to potential secret talks, U.S. and China.
Secret talks are standard, though, aren't they?
Well, yes, but it's what they're potentially talking about. The U.S. allegedly considering formally changing its stance on the One China principle, the really sensitive policy regarding Taiwan.
In exchange for what?
Things like China helping cut off fentanyl shipments, maybe better trade deals, stuff the U.S. wants domestically.
Okay, hold on. I mean, that sounds like tough negotiation, but is it really unprecedented? Don't countries always trade concessions?
Usually, yes. But what the sources argue is unprecedented here is treating the alliance structure itself as transactional. The One China principle wasn't just any policy. For decades, it was framed as this fundamental doctrine keeping the peace.
Ah.
So the Geneva Gambit idea is that this core security guarantee is suddenly like a tradable commodity.
Like putting your house deed on the table in a poker game over something unrelated.
Exactly. Imagine your bank saying your fixed rate mortgage is now somehow negotiable based on, I don't know, your neighbor's overdue credit card bill. The foundation just crumbles.
And this is where it gets really interesting for the market, right? The reaction.
Absolutely. The sources highlight Taiwan's foreign ministry immediately and publicly asking Washington for clarification. Hey, are you really doing this?
That public nervousness, wow, that's a signal in itself.
It's a huge market signal. It creates an immediate Taiwan risk premium. Investors see that crack in the bedrock of trust, and they price it in. Not just for Taiwan, but for all assets under that U.S. security umbrella, Korea, Japan.
So loss of confidence. The market thinks the U.S. might choose a quick deal over long-term doctrine.
That's the fear reflected in the pricing. And that instability gets worse with Pillar 2, U.S. strategic division, internal conflicts within the U.S. government.
Right, the sources talk about this clash, traditional defense hawks versus the America First crowd.
Precisely. They even mention analysis of a leaked draft of the National Defense Strategy, the NDS. And apparently it puts U.S. Homeland Defense priority right at the top, above global commitments.
I mean, prioritizing homeland defense, it sounds reasonable on the surface, doesn't it? Why is that so destabilizing for allies like South Korea?
Because it shifts U.S. policy away from what used to be called strategic ambiguity, keeping adversaries guessing towards something more like strategic inconsistency.
Okay, explain that.
Well, ambiguity could be a tool. Deterrence.
Yeah.
But inconsistency just means allies can't rely on you. If U.S. strategic priorities can flip based on, domestic politics or the latest trade demand,
then the security umbrella starts to look pretty leaky.
Exactly. It feels temporary, unreliable. And if you're an ally, you can't base your national security on something unreliable.
So what do?
They have to react and start thinking, okay, maybe we need to ramp up our own defenses much faster. Maybe even consider things the U.S. actively discouraged for decades, like, going nuclear themselves.
Which just adds more instability to the whole region.
Absolutely. And that reaction itself scares off foreign investment. Which brings us neatly to Pillar 3, weaponizing the alliance. Direct pressure on South Korea.
And this isn't just about tariffs, right? The sources describe something more intense.
Yeah, they call it compulsive diplomacy. It's basically the U.S. linking demands for huge economic investments, like there's an initial ask for $350 billion in investments into U.S. manufacturing.
Whoa, $350 billion. How big is that relative to, say, Korea's economy?
It's massive, a really significant chunk of their annual exports. But the U.S. linked that demand to unrelated security requests, like demanding South Korea get involved in patrolling the South China Sea.
Which is primarily a dispute between China and Southeast Asian nations, plus the U.S., not really Seoul's core security concern.
Exactly. So the U.S. is seen as using Korea's dependence on the security alliance to force it into confronting its biggest trading partner, China, over issues that mainly benefit Washington's strategic goals, not necessarily Seoul's.
Kind of like forcing your friend to pick a fight with their biggest client just because you don't like the client.
That's a pretty good analogy, yeah. The sources say the U.S. is weaponizing Korea's dependence.
Okay, but here's something interesting. The sources say when the Korean president's office publicly pushed back on those initial demands, the currency, the won, actually strengthened against the dollar. That seems backwards.
It does seem counterintuitive at first, but investors likely saw it as a sign that Korea wasn't going to be immediately strong-armed into costly destabilizing actions. Rejecting the upfront demands maybe signaled a limit to how much pressure Seoul would accept.
So a temporary sigh of relief from the market, less immediate risk of Chinese backlash.
Sort of. Less immediate risk, yes, but the underlying problem remains. If Washington can use these tactics, linking economics and security, then suddenly every major Korean export sector looks like a potential bargaining chip in U.S. foreign policy. That's a huge vulnerability.
Okay, let's shift gears slightly. How does all this geopolitical drama actually hit foreign investors in the wallet? Let's talk currency first.
Right. The Korean won, the KRW, it's what traders call a risk currency. Super sensitive to global capital flows, geopolitical jitters.
And right now it's facing a perfect storm.
Pretty much. You've got three things hitting it. One, general global risk-off mood, which usually pushes the U.S. dollar up. Two, specific local risk, because of all this alliance pressure we've discussed. And three, a potentially worsening trade picture, worrying about U.S. protectionism or Chinese retaliation.
So the one is becoming less about just trade flows and more like a confidence meter for the U.S. alliance itself.
That's a great way to put it. If confidence in the alliance drops, the one weakens. And the sources actually put numbers on this. They see an initial downside target around 14.51 to the U.S. dollar.
14.50.
And in a really bad scenario, like if tensions escalate dramatically, they talk about a tail risk of 1,500, maybe even 15.51 to the dollar.
Wow, those are levels we haven't seen since.
Since the global financial crisis, yeah, over 15 years ago. And the Bank of Korea, they can intervene, try to smooth things out, but they can't really fight this fundamental loss of confidence in the alliance structure itself.
And a weak one feeds right into the stock market, the KOSPI, doesn't it? Because so many investors there are foreign.
Yeah, exactly. It's a double whammy for them. Their returns automatically shrink just from the currency falling. Plus, the country risk premium goes up, which makes them demand a higher return for holding Korean assets. Put those together.
And you get massive selling. Foreign capital heading for the exits.
Right. Which brings up this interesting point about valuations. People look at the KOSPI and say, hey, the price-to-earnings ratio, the PE, is pretty low. Looks cheap.
Yeah, I'd ask that too. If it's cheap, shouldn't value investors be buying, especially if the market's panicking?
You'd think so in normal times. But the sources warn, and this is really key for investors, in a serious geopolitical crisis, valuation appeal is no defense.
Meaning the fundamentals don't matter as much.
In the short term, they get overwhelmed. Geopolitical risk isn't like normal business cycle risk. Investors demand a much higher structural risk premium. They need a bigger discount to compensate for the possibility of, major instability or even conflict. So what looked cheap yesterday suddenly doesn't look cheap enough given the new risks.
That makes sense. And that leads to the longer-term worry you mentioned, foreign direct investment, FDI.
Yeah, the FDI, that's the money that builds factories, creates jobs, the long-term stuff. And there's this idea of friendshoring happening globally, right? Companies trying to build more resilient supply chains outside of China.
Korea should be benefiting from that trend, theoretically.
You'd think. But if the whole region starts to look unstable because of these alliance issues and U.S. China tensions, those companies planning new factories might just pause or cancel.
So Korea could get structurally isolated, missing out on that investment wave because it's perceived as being too close to the fire.
That's the risk, a real chilling effect on long-term investment.
Okay, so this crisis isn't hitting everything equally. The sources talk about extreme polarization, winners and losers emerging at the same time. Let's start with the clear winner.
Overwhelmingly, according to these analyses, it's the K-defense industry. KJ, as they call it in Korea.
Hey, defense. Why them?
Well, think about the root cause of the crisis we've been discussing. Rising tensions, and maybe more importantly, uncertainty about the reliability of the U.S. security guarantee.
Ah, so countries in the region feel they need to defend themselves more.
Precisely. Especially countries in places like Eastern Europe, Southeast Asia. They see the tensions, they see the questions around U.S. commitment, and suddenly there's this exploding demand for self-defense capabilities.
And Korean companies are stepping up. The growth numbers are huge, right?
Massive. Sources cite something like 177% export growth just between 2017 and 2021. And it's because they have a compelling offer.
What's the offer?
High-quality weapons, often compatible with NATO systems. Think K9 self-propelled howitzers, K2 tanks. But they combine that quality with competitive prices, often much faster delivery times than Western competitors, and they are more open to transferring technology.
So quality, price, speed, and tech sharing. That's a potent mix.
Very potent for countries trying to modernize their militaries quickly without getting stuck in long approval queues from, say, Washington or European capitals.
So the key takeaway for investors. Defense stocks become a direct hedge. They benefit from the very risk that's hurting the rest of the market.
Exactly. It's a direct counter-cyclical play in this specific geopolitical context.
Okay, now for the tricky one. Semiconductors. The sources call this ambiguous.
Yeah, it's a real double-edged sword. The absolute nightmare scenario, the catastrophic risk, is any kind of military conflict that shuts down TSMC in Taiwan.
Because TSMC makes almost all the advanced chips.
Something like 92% of the really high-end stuff, losing that. I mean, the COVID chip shortages would look like a minor hiccup by comparison. Global economy grinds to a halt.
Okay, that's the nightmare. But there's a potential upside for Korean chipmakers, the reflection benefit.
Right. If the crisis stays sort of contained, maybe naval blockade, lots of tension, but not all-out war-destroying facilities, then global companies who suddenly realize their 92% dependence on Taiwan is terrifyingly risky.
They might look to diversify, shift orders.
Exactly. And who are the other major players, especially in memory and increasingly in foundry services? Samsung and SK Hynix in Korea. So you could see a tactical shift. Orders moving to Korea to spread the risk, especially for things like advanced foundry and high bandwidth memory, HBM, which is crucial for AI.
But let's have the caution flag here. Is that a reliable long-term shift?
The sources suggest it's more tactical, more short-term. Korea isn't exactly a safe haven insulated from all this. It's geographically right there.
Right.
Plus, you have other pressures like potential U.S. restrictions on selling advanced chip-making gear to Korean facilities in China. So foreign investors might just throw up their hands and say, you know what, Asian tech is too risky right now, and sell everything Samsung, TSMC, the lot.
So potential short-term gain, but still caught up in the broader regional risk. Got it. Okay, finally, the clear high-risk losers identified in the sources: auto, batteries, and logistics. Why are they so exposed?
Basically, they're caught in the crossfire between U.S. protectionism, potential Chinese retaliation, and this compulsive diplomacy we talked about.
Take cars, for example.
Huge reliance on the U.S. market,
Right.
right? Hyundai, Kia sold, what, 1.7 million cars there last year? If the U.S. decides to slap on new tariffs or use market access as leverage in these geopolitical games.
Profitability takes a massive hit.
Devastating.
Yeah.
And batteries, even though they're building huge plants in the U.S., like in Georgia.
They're still vulnerable. How?
Supply chains.
Yeah.
They still rely heavily on Chinese components, Chinese processed minerals to actually make the batteries in those U.S. plants.
Ah, so those billions invested in U.S. factories are kind of exposed.
And the sources actually use the word hostages.
Yeah.
Those investments are hostages to U.S. policy shifts on trade, on China, on supply chains. A sudden rule change could cripple production overnight.
Wow. Okay, and lastly, logistics and energy. This sounds like it affects everyone.
It's systemic. The Taiwan Strait, the South China Sea, huge amounts of global trade pass through there. Over a fifth of maritime trade, the sources say.
So any disruption, blockade, conflict?
Forces ships onto much longer, much more expensive routes. For an export-driven economy like Korea, that's crippling. Shipping costs explode. Competitiveness plummets. Plus, energy import costs would spike too, since they import most of their energy via sea routes. It hits the entire economy.
So putting it all together, this deep dive suggests we might be seeing the end of a very successful era for South Korea, that balancing act between U.S. security and Chinese economics.
It looks like that model is under extreme stress. That triple pressure is forcing a strategic rethink, not just for Seoul, but really for any global investor with exposure to the region.
So for you, the listener, the investor, what's the actionable takeaway? Hedge the risk.
Actively hedge, yes, especially against this U.S. policy inconsistency risk. The consensus strategy coming out of these sources is pretty clear. Underweight Korean one-denominated assets, reduce exposure, and overweight global safety assets.
Okay, safety assets. Does that mean run to the U.S. dollar? That's the traditional safe haven.
Well, the dollar is expected to remain strong. Anytime there's global fear, global uncertainty, everyone needs dollars for liquidity. It's still indispensable.
Huh.
But what's really fascinating is that the sources identify gold as potentially the superior safety asset right now, even better than U.S. Treasuries.
Gold over U.S. government debt. Why? That's a big call.
Because gold is completely separate from any single government's credit risk. And crucially, in this specific crisis, it's decoupled from the very instability being caused by U.S. policy volatility and internal political divisions.
Ah, so if the crisis stems partly from a loss of faith in U.S. predictability, U.S. treasuries might be slightly tainted by that same uncertainty, whereas gold stands apart.
Exactly. Gold offers that non-fiat, non-political hedge against the specific risks driving this scenario.
Okay, that's a powerful point. So this whole situation seems to be accelerating the shift away from those super efficient but maybe fragile just-in-time supply chains.
Definitely. The new buzzwords are resilience and security, even if it costs more.
Which leaves us with a big question for you to think about. This move towards friend-shoring, rebuilding supply chains based on political trust rather than just cost, how is that going to redraw the map of global manufacturing over the next 10 years? And, more importantly, where should your capital be positioned to navigate this new, potentially more expensive, but maybe more secure world?